Hi there, welcome to the BDC Roundtable and our panel on what is new in valuation and derivatives. My name is Ray Ramirez. I'm a partner here at the firm, and I focus in the derivative space, which really means I'm a regulatory and transactional lawyer. I'm joined by Patricia. Patricia, do you want to introduce yourself?
Absolutely. Patricia Luscombe, Managing Director, co-head of Lincoln Valuation Group. Lincoln's Valuation Group has a large practice determining fair value of liquid investments. We work with about 100 alternative asset managers, many of which are public and private BDCs. Pleased to be here today.
Thanks, Patricia. And we're also joined by Dwayne Dupree. Dwayne, do you want to introduce yourself?
Yes, thank you, Ray. My name is Dwayne Dupree. I'm counsel here in the Capital Markets Group, focusing on regulation and of BDCs.
Thanks, Dwayne. Today we're going to cover three topics. We're going to cover a new rule change regarding the valuation of fund valuation practices, excuse me. We're going to also cover Rule 18F4, which is also a new rule from the SEC that covers the use of derivatives by funds. And then we'll talk a little bit about commodity pool operator requirements. Let's jump into the fund valuation rule. And I'm going to start with you, Dwayne, by asking you to give us just an overview of this rule that I understand was adopted in December of 2020.
Thanks, Ray. So under the 40 Act, a BDC board of directors is responsible for determining the fair value of a BDC's portfolio securities when market quotations are not readily available. So under current SEC guidance, this is a non-delegable obligation, and the BDC board must specifically determine the fair value of the assets by itself. Not by itself, but with help, but they must actually do it. Although there are a number of ways that BDCs satisfy this obligation, most BDC boards carefully review fair value recommendations from their advisors or third-party valuation experts. They periodically review their advisors' valuation methodologies, and then they specifically determine or approve fair value of portfolio securities on a quarterly basis. Each BDC's valuation process is a little different, which can lead to variations in the amount of information presented to each BDC's boards. So the purpose of the new rule, which is Rule 285, as you mentioned, is to establish a minimum consistent framework for the fair value and standard baseline practices across funds for valuation. The rule also brings the valuation guidance a little bit closer to current accounting practices. So the rule clarifies existing law and formalizes the process that many BDCs already undertake. First of all, the new rule defines when market quotations are readily available for purposes of the 40 Act. The next big item is that the rule allocates responsibilities of making fair value determinations between the board and an investment advisor. Specifically, the rule gives the BDC board the option of determining fair value itself or delegating its responsibility to the investment advisor, who will serve as a valuation designee. The third thing the rule does is sets out standard reporting and record-keeping obligations for the valuation process. And finally, the rule gives the board clear guidance on fulfilling its obligations under the 40 Act, and if there is a valuation designee, that means it's oversight of the valuation designee. The rule is mandatory after September 8th, 2020, but boards can comply with the rule before that if they would like.
Thanks, Dwayne. And Tricia, I'm going to turn back to you to dig a little bit into the items that Dwayne mentioned. So let's start off with this new framework for determining when market quotations are readily available. Can you tell us a little bit about, why this is important in terms of valuation?
It's important because it really kind of sets a line between when the board has responsibilities to determine valuations in good faith and when it does not. So when it does not, as Dwayne mentioned, is when that market quote is readily available. So what that means is that market quote has to be a quoted price in active markets for identical investments that the fund can access at the measurement date. So in other words, how I think about it, it's really consistent with the level 1 guidance under US GAAP. Level 2 inputs or evaluated prices from pricing services, broker quotes without actual trading are not considered readily available. A quote that has an adjustment associated with it or additional inputs to determine fair value under US GAAP is also not readily available. So it's in that set of circumstances that fair value would have to be determined by the board in good faith.
Got it. Got it. And the rule also allows a fund's board to appoint a valuation designee. And that's going to be the investment advisor. I understand that this is a pretty significant change. Can you walk us through the role that the valuation designee is going to play and the valuation process?
Yes, so the valuation designee is going to be responsible for preparing the valuations and all of the information surrounding the valuations. But I think it's important to call out that the board ultimately still approves the valuations. So by having a valuation designee, it doesn't really absolve the board from providing effective oversight of the fair value determination process.
And what are the valuation designee's obligations? How does it fulfill those?
Yeah, so there's really 4 key areas that are outlined in the guidance. The first one starts with periodically assessing and managing valuation risks. And it's interesting because the SEC didn't want to be too prescriptive really in any of its guidance. So it doesn't really say much about the frequency that valuation risks must be assessed or exactly what constitutes a valuation risk. So in general, I'd say assessments and valuation risks should consider, changes in fund investments that may be harder to value type investments than previously, market events that have been highly disruptive to market data. We look back to March of 2020, times of high market volatility, drying up of market liquidity. Those types of events would have to be, assessed as an increase in risk for valuation. Also, reliance on service providers, maybe with limited experience in relevant asset classes, and then any use of inappropriate valuation methods. So those are all under the guidance of assessing that valuation risk. The second area that the designee is responsible for is establishing and applying fair value methodologies. And so they have to select and consistently apply methodologies that are appropriate for that particular asset. As we mentioned before, unlike previously, that value actually should be consistent with ASC 20, the GAAP fair value guidance. And just to say that the SEC recognizes that there's really no one methodology that kind of one size fits all from a valuation perspective, may be appropriate to have a range of fair values to be considered for a particular investment. I'd say particularly with BDCs, the SEC noted that fair value generally should not be par or amortized cost unless that would be the current exit price for that security, which would reflect both the fundamental issuer performance and market conditions. So the third area that the designee is responsible for is testing then. So once they've consistently applied these fair value methods, they then have to test, are these methods working appropriately? And the SEC mentions 2 concepts. I believe we're going to be talking about these concepts a bit later. One being calibration and the other being backtesting. But there's no requirement by the SEC to use either calibration or backtesting. But it does seem to be a best practice with the designees to use both of these methods for testing. And then finally, as you had mentioned, the designee is really responsible for evaluating pricing service. And so that valuation designee must establish a process for approving, monitoring, and evaluating each pricing service provider and initiating pricing challenges. Within that, I would say the role, and this is, Lincoln's role, we really believe our role is to assist that valuation designee or board in the determination of fair value. We recognize that we're really just one input into the process, that ultimately it is, the board's determination. So we work with our clients, in a number of manners, and some clients we, present them an independent range of fair value to the valuation designee, or other clients, it may be assurance on the reasonableness of our clients' determined fair values. Also, the other area that seems to be different across clients is how we're involved with those clients. So the frequency. So for some, fund clients, we value 100% of the portfolio every quarter. For other clients, we value 25% of their portfolio every quarter. So over an entire year, we've looked at 100% of the portfolio. So our practices that we get involved with the designee or the board itself do vary.
Thanks, Tricia. And I do want to talk a little bit more about the valuation designee's obligations, but before we get there, let's talk about the backtesting requirement first under the rule. Companies may not be familiar with this. So can you tell us a little bit about that backtesting requirement and how you can fulfill that requirement, or the valuation designee can fulfill that requirement?
Yeah, so as we've mentioned, it really comes into play for that valuation designee to test fair value methods. In other words, what backtesting is trying to capture is really how effective are the fair value models to actually predict the exit price for the investment. So what backtesting does, it compares the model determined fair value price prior to the exit with the actual exit price. And under the record-keeping requirements of the new valuation rule, valuation designees have to present a summary to the board of the testing results. And I know that backtesting has always been a best practice with many of the fund managers, but now it's officially required to report the testing results to the board. And I'd say Lincoln, as a valuation service firm, we also have a backtesting database in which we track our own performance. How did our models compare to the actual exit price? And we've historically have reported those results to some of our, fund clients, the valuation designees, but we expect we'll be reporting a lot more of those statistics regularly to the valuation designees.
Thanks. And there seems to be a challenge here with the valuation process, which I want to talk a little bit about, which is that you have to segregate the personnel that are going to be making the fair value determinations from the folks who are making the trading decisions, the portfolio managers for the funds. And the goal of that is to avoid conflicts of interest. But the problem with that is that the portfolio managers often have information that's relevant. So how do you, what recommendations do you have for folks that might be watching this for addressing these types of conflicts?
Absolutely, and it's always been a fine line in our experience, but I think it's important to call out that the fair value rule doesn't preclude portfolio management from providing input into the fair value process, but what it attempts to do is really limit the amount of influence that portfolio managers have on the ultimate determination of fair value. I think it's also important to note that the SEC does allow a little bit of leeway to structure the valuation process based on the size of a fund and its internal resources. I know some of our clients may not have the resources to have a separate valuation team from the portfolio management team. So what we've seen them do is kind of this segregation can really be achieved, I'd say, through independent reporting chains. I'd say most frequently what we've seen is some sort of valuation committee that ultimately determines or recommends a fair value, which is comprised of both accounting and portfolio management team members. But in terms of our day-to-day and the best practices we've seen, I'd say we interact primarily with the accounting, the valuation team to drive that fair value process, make those fair value recommendations. But then we get our information on the portfolio company investments from input from the deal teams who are most in the know about the performance of these investments. And so typically we've seen the accounting valuation teams will want the ultimate kind of portfolio management team to sign off on the recommended valuations, but it is still under the accounting valuation team to be responsible for the fair value determination and not the deal team. So in other words, it's a combination from both, but I'd say the driver of the valuation process is really from the accounting and valuation team.
Thank you. And I want to talk a little bit about the last item you mentioned earlier about the evaluation of service providers, right? So the valuation designee is required to evaluate the performance of those third-party service providers like Lincoln. So what type of information do you see valuation designees request from service providers? Are there any type of certificates or assurances that you typically see being obtained by those valuation designees?
Yeah, so typically, when we're working with a potential new client, we meet with the valuation designee and then ultimately meet with the board. They want to know about our experience and history of valuing, the particular investments. They want to know the types of methodologies we're going to employ to determine the valuations. They want to know the source of the data that we use and to understand that it's appropriate for that particular asset class. They also want to know about potential conflicts of interest, how we mitigate that conflict of interest. They want to know about how we handle price challenges, and then backtesting. What's been our backtesting results? How successful are our own models in predicting the actual exit price of the investments. And in terms of certifications or anything like that, I don't think there really is, an official, certification, that we provide. Obviously, we have our collective experience, our education, and the like. And we believe that it's ultimately those types of qualifications that will drive success and improve the valuation process for our clients.
Thanks. And I think we have to recognize this world that we're living in. COVID-19, Tricia, what's been the impact? Do you envision it having a lasting impact on the valuation process? Tell us a little bit about that.
Yeah, no, that's a really interesting question, and Ray, just really happy you're asking that question because it made me think a bit. And so I kind of thought there were three areas that would have a lasting impact due to COVID on the valuation process. So the three areas, number one, I think it really kind of, struck us all, the importance of using appropriate data to drive the valuations. And I think a good example of this was in Q1 and Q2 of 2020. With BDCs owning private credit, if one had looked to what was going on in the broadly syndicated markets, as of March 31st of 2020, the broadly syndicated market traded down to, roughly 80 cents on the dollar. So implied yields, implied spreads went way up. And so if we had used that data alone to drive the values for private credit, that would have led to, incorrect fair values for private credit. We always think of fair value private credit's much more stable. It's driven primarily by business and financial fundamentals. And so using markets, broadly syndicated loan market data, particularly during times of market dislocation, may not make sense. So I think that's one area, is understanding the data you're using and is it appropriate for private credit. The second area is the importance of getting the manager's outlook of a business. And, as we all know, the latest 12 months of financial performance prior to COVID was vastly different than what happened during COVID. And so what we did during that time period to get the outlook of the valuation designee and the managers, as part of this, many of our clients had really categorized their portfolio into high, medium, and low COVID impact. We used their assessments and their outlook for these businesses to really help us, frame our fair value for these investments. So, and then the third area, I think, which COVID highlighted, was having well-supported valuations. Whenever we go through, a time of great market uncertainty, valuations are a lot more challenging. They're going to draw a lot more questions, whether it's from the board, whether it's from the auditors. So it's important for valuations to reflect thoughtful analysis. So those are some of the impacts, lasting impacts from COVID.
Well, thanks, Tricia. Dwayne, I want to get you back in here for a minute. I know that the rule changes a fund's board, the role that a fund's board plays in the valuation process. So can you tell us a little bit about what those changes are to the board governance process?
Sure, Ray. And I think the good news here is that most BDC boards perform a lot of the tasks that the new rule requires. Mainly, they're skeptical of information, they ask questions, and they delve into areas when there are red flags. But under the new rule, I think what boards will find is that the process is a lot more formalized, and they should expect to receive a lot more reporting than maybe some boards are used to, and those reports will have required information in them as required by the rule. So under the rule, the valuation designee is required to provide periodic reporting. That's on a quarterly and an annual basis. And in these reports, the valuation designee has to provide specific information to the board about the valuation process. There's also a prompt report that is required if there is a material event that affects the value of portfolio securities, and that report is required within 5 business days after the event happens. So I think the board will see a lot more reporting. The board should also expect to see reports regarding the valuation methodology and more reports on the work of third-party service providers. As Tricia mentioned, backtesting, for example, the board is required to receive reports on how the backtesting is working, which reflects the valuation methodology that the valuation designee is using. So the board may also receive data-driven reports like trend dashboards and analytical tools, which the rule suggests would be helpful for the board. Finally, as Tricia mentioned and you talked about, we expect that the board will receive more information about potential conflicts of interest during the valuation process. So how is the valuation designee managing those conflicts of interest? What guardrails are set up to avoid conflicts of interest in that process? So I think Tricia also mentioned this. The board, under the new rule, the board is they fulfill their obligation through oversight. So the board is not actually required to ratify the valuation of the valuation designee, but the board has to remain informed. So the board will receive a lot of information that is required, but we also suggest that the board actually work with the valuation designee, work with the advisor to get information that it believes to be important. during the process. So an active board is going to be really key under the new rule, and the new rule just sets a minimum threshold for what the board should be doing.
Thanks, Dwayne. Tricia, do you want to weigh in here on what the board should be expecting to receive from the valuation designee or third-party service providers, or maybe they should be requesting from them?
Yeah, and Dwayne, you did a great job covering, a lot of information. And I know from our perspective, we think, that the board will likely want to know more about some of the harder to value investments, and spend some time, understanding how fair value was determined for those types of investments. They also want to know how assumptions have changed quarter over quarter, what's happened to market conditions. And then the other area, how have any fair value methodologies changed quarter over quarter? As mentioned before, there's no one methodology that, fits all investments. And it's possible for underperforming investments in particular that valuation methods may have changed quarter over quarter. So, and I think the other area, just to call out, is the whole price challenge process. I think the board will want to know, have there been any, disagreements, overrides of, fair value between the valuation service provider and the valuation designee.
Thanks, Tricia, for that. All right, well, compliance with 2A5 required in September 2022. Let's get a last word here from each of you. Tricia, what should valuation designees be doing to get ready, and in terms of implementing the new rule?
Yeah, I think of it as likely the valuation policies and procedures will need to be updated. As we've mentioned, the new fair value guidance is really consistent with ASC 820. The exit price, which looks at the exit price as fair value for an investment. I think the other area that we've talked about is, what is the guidance of when a fund should make a fair value determination? So if there are situations where an investment was, had a readily available market quote, it becomes less liquid, or trading activity has halted, slowed down. It's those types of situations that probably should be outlined, that they would then become fair valued under the new fair value guidance rule. So that should be outlined in the policies and procedures. We touched on really the price challenge process. Is it being consistently applied? What information is shared with the valuation service provider? If there is a price challenge process, how does it get resolved? And then I think also, the testing, that back testing, how is that going to be conducted, and how are the results going to be shown to the board? So I think those are some of the areas that the policies and procedures will need to be updated for.
Thanks, Tricia. And Dwayne, what should BDC boards be doing to prepare?
I 100% agree with Tricia on the valuation policies. Particularly, the board should be, they should have a huge part in determining, sort of what those valuation policies would be, and understanding the valuation policies. But the first thing I think the board should actually do is decide whether they want a valuation designee at all. We assume that most boards will want a valuation designee, because this is generally the way the BDCs operate currently. So assuming there is a valuation designee and the board wants the investment advisor to act as such, they will need to formally designate them as the valuation designee. And this is should be a serious process. They should look at what resources the investment advisor has for this, their credentials, and then if needed, supplement that with third-party valuation experts like Lincoln to get that process done. So they'll need to start that process, and we think it should be a fairly detailed process about designating a valuation designee. We also think, in addition to updating the valuation policy, the board should work with the valuation designee to figure out what information they believe will be the most helpful to the board. So as we mentioned, there's all this required reporting that is required under the rule and required record keeping, but those are minimums. So the board may want actually more information than is required under the rule, and the board might want the information to be organized in a certain way. So we encourage boards to work with the valuation designee, if there is one, to determine what information the board finds the most helpful. Another thing, we talked about conflicts of interest. We think that the board should be pay much attention to conflicts of interest and should be involved in the process for ameliorating conflicts of interest when they arise. We think that will take a lot of work on the board's part, and perhaps with an outside advisor. The final thing we think is that the new rule has a lot of record keeping policies and a lot of other policies. So the company may want to update their compliance manual to make sure that all these policies are they're keeping track of all the record keeping requirements, and to also make sure that the valuation designee is keeping up with those requirements.
Thanks, Dwayne. Thanks, Tricia. Let's switch gears. So we've covered off a new significant rule. We're going to now cover another one, which also will come into compliance in 2022. So Rule 18F4, fund use of derivatives. It's a long time coming. Dwayne, do you want to give us some background on this new rule and the prior framework and what we're expecting going forward?
Sure. So under the current guidance for derivatives, the BDC's use of derivatives is in release 10.666. 10.666 is very broad, and it's been interpreted as applying to contractual obligations to make a payment in the future for consideration that is received presently. So what this means is that a lot of ordinary course transactions are potentially subject to 10.666. These transactions include standby commitments, forward purchase agreements, and significantly unfunded commitments. So under 10.666, a future contractual obligation is treated as leverage for purposes of a BDC's asset coverage test. However, the company has the option of covering future obligations with specifically segregated assets, in which case the SEC will not require those amounts to be treated as leverage. So the new rule 18F4 changes this scheme in a few ways. First, the new rule only applies to derivatives transactions, which the SEC specifically defines. In doing so, the SEC excludes certain transactions, which really shows that the SEC thinks that all future payment obligations don't have the same type of inherent risks as the risks involved in traditional leverage. So the second thing the rule does is for funds that engage in a material amount of derivatives transactions, the rule mandates an outer limit for the leverage risk, and it also requires a comprehensive risk management program, which includes board oversight. So this really is a risk management program that has to be implemented under the new rule. Notably, the rule does eliminate the asset segregation requirement, though. So as long as you comply with the risk management rules and the other tests, which is a value at risk test, then you do not have to segregate assets. Third thing that the rule does, it provides an exemption for certain limited derivatives users from the risk management program and other requirements. We'll talk a little bit more about limited derivatives users later. And finally, the rule implements some new record keeping and other compliance requirements that you have to keep up with. So the new rule goes into effect in August of 2022, and it's mandatory after that time, but companies can choose to rely on the rule before that date if they want to.
Thanks, Dwayne. And in terms of the types of instruments to which the new rule applies, what are derivatives transactions under this rule?
Yeah, so the rule generally defines derivatives transactions as swaps, futures, forward contracts, options, combinations of those instruments, any short sale borrowings, and certain reverse repurchase agreements. Significantly, the rule specifically excludes unfunded commitments from the definition of derivatives transaction, provided that a company believes that it can satisfy the commitment at the time that it is made. The rule also excludes certain other transactions from the being a derivatives transactions, including delayed settlement cycle securities, as long as those are physically settled within 35 days. Also, companies are not required to include currency or interest rate hedges when calculating their derivatives exposure under the limited derivatives user threshold. And I know I just introduced two new terms there, Ray. So I was hoping you could help me explain what a derivatives exposure is,
Sure.
and what the significance of being a limited derivative user is under the rule.
Sure, absolutely, and happy to switch roles a little bit. So derivatives exposure, for those of you who engage in derivatives, the use of this term and its definition don't really jive. For purposes of this rule, derivatives exposure means gross notional, and it's not a measure of market exposure or risk or anything like that. It's just gross notional. And the reason that the commission is using this test, the term derivatives exposure being gross notional, is because they're really just trying to figure out who are big derivatives users and who are not big derivatives users. So you'll note that this definition really is a blunt instrument, but you have to understand the purpose, which is really just to distinguish between folks that are big users and not big users. And that distinction is relevant for a key exemption that exists under the rule, which is for limited derivatives users. And we're going to talk a little bit about the requirements that the new rule imposes. Dwayne previewed them, but I think it's important to note that the rule has this exemption that says if you are a limited derivatives user, you don't have to comply with any of these requirements. All you have to do is adopt a policy and procedures that are appropriately tailored to your use of derivatives and address the risk of those derivatives for your company. So it's a big exemption. And to qualify for the exemption, your derivatives exposure has to be limited to 10% of less of the company's net assets. So there's a 10% test. If the derivatives are less than 10% of your net assets, you're a limited derivatives user. You don't have to worry about all the onerous requirements of the rule. Now, Dwayne, you mentioned this, but I just want to underscore it. For purposes of running that 10% test, you can carve out hedges of interest rate and currency risk. And that's pretty significant given what BDCs do. So we expect that the vast majority of BDCs will be limited derivatives users. Now, that doesn't mean that this rule doesn't apply to you at all. It just means that you don't have to, you don't have to implement an entire new program. You could just have a derivatives risk policy that's appropriately tailored and not have to appoint, a derivatives risk manager or the like. Now, another thing that's important to point out is that if for whatever reason you exceed that 10% threshold, so let's say you're a limited derivatives user and then you end up going above that, accidentally, your advisor has to report to the board as to why that happened, and it has to indicate how it's going to reduce the exposure promptly. Now, there's an outer limit on that reduction of exposure below 10%, which is 30 days. So if you exceed the 10% limited derivatives user exposure test, you basically have 30 days to come into compliance with that 10% test. Otherwise, the full panoply of requirements will apply to you.
That's right, Ray. And so I guess what happens if you either exceed the 30 days or if you don't qualify as a limited derivatives user at all? What do those requirements look like under the rule?
Yeah, a lot of bad things. So the first is an overall limit on leverage, right? And you mentioned this earlier, but there's a value at risk test. And basically, there are two options under that test. The first is a default, which is that a fund needs to look at its portfolio's VAR and compare it against the VAR of a designated portfolio, Now, the fund or its derivatives risk manager, which I'm going to talk about in a minute, comes up with that designated portfolio, and it has to be appropriate to the fund's investments. But at the end of the day, you compare it against your VAR against this designated portfolio. And if your VAR exceeds that designated portfolio, rather, your VAR cannot exceed more than 200% of the designated portfolio's VAR. And you have to test that every day. So on a daily basis, you're checking VAR to determine, am I below that 200% limit? If I'm not below that 200% limit, you have to take action right away. So that's your outer limit. Now, a designated portfolio may not be appropriate in every instance. And so the rule recognizes that and it imposes a distinct VAR test, which is basically derivatives can't exceed 20% of your net assets. So the VAR of your portfolio cannot exceed 20% of your net assets. Now that absolute VAR test is only applicable if you don't use a designated portfolio VAR test, which is a default under the rule. So that's the first thing. The second thing is you have to implement a derivatives risk management program. And Dwayne, you mentioned this. It has to be a written program, and it has to satisfy a number of different requirements under the rule. Now, all of these are intended to manage risk attendant to the use of derivatives. So you need to take into account leverage risk, market risk, counterparty risk, liquidity risk, etc. It also has to provide for the establishment of guidelines, both for risk management as well as what the company is going to be doing in terms of the derivatives it's going to engage in. Weekly stress testing is required. Weekly back testing of the VAR calculation is required. And you also have to build in reporting mechanisms for the derivatives risk manager. We're going to talk about that in a second, reporting to the board as to the effectiveness of the program and ensuring that not only are you complying, but it actually is reducing and addressing the risks that are attendant to the company's use of derivatives. So that's the second big requirement. Third big requirement is the appointment of a derivatives risk manager. And this is significant. It has to be a natural person. It has to be an officer or officers of the fund's investment advisor, but it cannot be the advisor itself because, again, it has to be a natural person. Also, the derivatives risk manager cannot be a portfolio manager for the fund, except that if you have multiple persons that are designated as derivatives risk manager, then there can be portfolio managers, but the majority of the folks who are the derivatives risk managers cannot be portfolio managers. And then whoever is a derivatives risk manager has to have appropriate experience and be able to actually implement the written program. Now, in terms of the derivatives risk manager's primary role, really it's twofold. It's designing and implementing the derivatives risk management program, and also routinely and regularly reporting to the board as to the implementation of that program, and addressing instances where stress testing is appropriate, or there shows issues, or the VAR tests inadvertently are exceeded. That has to be reported to the board. So that's the derivatives risk manager's role, and it's important to flag that this derivatives risk manager, the concept is really meant to take some of the onus that was in prior iterations from the fund's board. So the thought process here is the derivatives risk manager is primarily responsible for derivatives trading or overseeing the derivatives trading of a fund and ensuring that risk is appropriately managed. The board is approving the appointment of the derivatives risk manager, but aside from that, is really looking to the derivatives risk manager to ensure compliance with the rule. The board itself is overseeing, but primary responsibility falls with this individual or individuals. And then the last thing is record keeping and reporting. A number of existing forms have been tweaked in light of the requirements that the new rule imposes.
Thanks, Rick.
So Dwayne, 2022, I've just gone through this litany of things that people have to do. What should folks be doing to prepare now?
So I think the very first thing to do is figure out what your current and anticipated derivatives usage is going to be. Because we expect, like you said, Ray, most people to be limited derivatives users, but you need to verify that. So the first thing is looking at your derivatives use, figuring out what you expect it to be. If you anticipate being a limited derivatives user, you should consider what type of derivatives you anticipate using, and then work with the board, work with the investment advisor to come up with a policy, derivatives policy, because that is required if you're a limited derivatives user. So if the company expects that it will not be a limited derivatives user, I think what you need to do is work with counsel to figure out how to develop and implement a written derivatives risk program. As Ray just went through, it's very detailed. It requires a lot of calculation, and it potentially requires you to have specialized staff who are able to actually manage this program. So that's a lot larger undertaking than being a regular limited derivatives user. The second thing that you should probably do is revise your compliance policies to take into account the derivatives program that you mentioned, whether this will be required, whether you're a limited derivatives user or not. Additionally, you'll need to have their separate record keeping requirements, as Ray mentioned. Those requirements are a lot more onerous if you are not a limited derivatives user. So again, a lot of attention has to be paid. The distinction between the limited derivatives user and not being a limited derivatives user is pretty significant in this area. And so the board should definitely pay attention to that, and also pay attention to how it is monitoring its derivative user usage to make sure that it doesn't trigger these thresholds above the 10% threshold for more than 30 days if it's a limited derivatives user. And if it's a more significant derivatives user, monitoring it to make sure that it doesn't fall into the limited category, in which case it wouldn't have to do the compliance program. Ray, I want to switch topics for a little bit. And since we were talking about derivatives, I want to talk a little bit about CFTC compliance, because it might be something that kind of falls off of people's radars. Can you tell us a little bit about the commodity pool operator regime and how that fits into derivatives conversation that we were having earlier?
Yeah, absolutely. I think, it's important to realize when you're adopting policies and the like that the use of derivatives and the regulation of derivatives doesn't exist in a vacuum, right? So you've got the SEC rule, but the derivatives themselves are subject to regulation by the CFTC or potentially the SEC, depending on the type. And for the vast majority of derivatives, they do fall under the Commodity Futures Trading Commission's jurisdiction. For BDCs in particular, the thing that we often see come up is commodity pool operator status. So very quickly, a commodity pool operator is a person who essentially operates and manages a pool of funds that has the ability or does invest in derivatives. And the CFTC is pretty aggressive in its definition of these terms. Really, the use of even just one derivative is sufficient to trigger the commodity pool operator regime. Now, a commodity pool operator is basically like an investment manager, right? But it's a category of person that is required to be registered with the Commodity Futures Trading Commission and is subject to myriad compliance obligation, reporting, record keeping, disclosure, et cetera. And so they're a registrant under the CFTC regime. So that's basically, if you're doing derivatives, if you're a BDC or other fund doing derivatives, entry into a derivative in and of itself is enough to implicate the commodity pool operator regime.
So Ray, I think you just gave a bunch of people a heart attack, maybe just now. So can you talk about whether there's any exemption from the CPO regime and how you qualify for that, if there is one?
Absolutely. So even if you are a CPO, that doesn't necessarily mean that you're going to have to register as a CPO. There are a lot of exemptions and exclusions that are available, and there is one that is specific to BDCs. And so BDCs are able to avoid commodity pool operator registration if they comply with a couple of requirements or criteria for exemption. And really those are, the exemption is it's under CFTC Rule 4.5, and it basically says, if a BDC engages in a de minimis amount of derivatives trading, then CPO registration is not implicated. Now that term de minimis trading is defined, and it's really an either or test. So the first test is a notional test. So you compare your notional against the liquidation value of the portfolio, and you can't exceed 100% of the liquidation value. So the notional cannot exceed 100% of the liquidation value of the portfolio of the BDC. The alternative test is a margin test, right? So what you're going to look at is the gross, rather the aggregate initial margin, premium, et cetera, that you are required to establish, that you are required to post to establish a derivatives position cannot exceed 5% of the liquidation value of the BDC's portfolio. So you can meet either of those tests, and if you meet either of those tests, then you don't have to register, but you do have to claim an exemption.
Okay, hopefully people's fears are allayed. So what are the ongoing kind of compliance obligations that you have to have, if there are any, with this exemption?
Absolutely. The first is you have to claim the exemption. So there's it's ministerial, very easy to do, but you have to claim the exemption affirmatively, and you have to reaffirm it annually at the beginning of each year. So that's the first thing. And then the second thing is you have to monitor, conformity with the de minimis thresholds. That's important. If you exceed those, then obviously you don't qualify for that particular exemption. You have to either look for another exemption or register a CPO. So those are really the two primary compliance obligations, aside from compliance obligations that are attendants of the use of derivatives generally, which we've talked about a little bit here, and which have been imposed under Dodd-Frank, and folks are probably familiar with already.
Great, great. Well, I think they're giving us the sign to wrap it up. So thank you, everybody, for joining us today in this panel, and we hope you are enjoying the BDC Roundtable. If you have any questions from either of the panelists on this panel, our contact information, I am told, will be displayed. So please reach out to us, and we hope you have a great rest of the BDC Roundtable. Thank you.